Greetings, it is time for another CrashWatch video, since I have not done one in about 3 weeks. And for a summary of all the concepts that have been discussed in prior CrashWatch videos, the links to the prior videos are going to be in the description box below. So to summarize, this is the S&P 500 5-year chart, and this huge rise was because of the Federal Reserve money printing as well as fiscal stimulus by the US government during the COVID-19 crisis, and this is being unwound right now. The classical indicators that have already taken place are this head and shoulders pattern in the S&P 500. Left shoulder, a head, and a right shoulder. And this distortion to the right shoulder was only because of the invasion of Ukraine by Russia, which caused a market correction sooner than the market would have otherwise wanted it to occur. But then it reverted back to complete the right shoulder. And this is the neckline here. And the head and shoulders pattern is a test where if the neckline breaks after the right shoulder, then you have a much deeper and more lengthy correction. And this neckline broke, just like I indicated in one of the prior CrashWatch videos. So this neckline over here broke, and now it is kind of hovering around here in this lower level below the neckline. So this is already a correction stage, but there's much lower to go. Based on this trend and the tightening that is occurring and the retrenchment that I expect in the real estate market, the bottom of the S&P 500 could very well be over here, 3,000. That is much, much lower than where we are now, but it's still pretty high relative to 2018, 2019. So consider this within the grand scheme of things. This, of course, will lead to a recession because the strange situation about all this is human psychology is such that any regression from a high point is seen as bad, but when the high point was so artificially high due to extraordinary circumstances, you have to have a 20, 30, 40% fall from the high point just to get back to what was actually the equilibrium trend line level. So let's look at this head and shoulders pattern on a 2-year chart. Left shoulder, neckline, head, neckline, right shoulder. Now we're back down to here. It's bumping around over here, but there are other pressures that are building up as we speak. And that is what is going to make this go lower to 3,000, in my humble opinion. Again, the standard disclaimer applies. I'm just teaching you how to look at these charts, and this video will be useful even a year from now, 2 years from now, because I'm talking about fundamentals. Use this information to do your own research and come to your own conclusions. Don't make any trades specifically because of this video. I am only providing this information for educational purposes. So if you look over here, you see this downward shift, and the fact that it's gradual is somewhat better. That means it's less of a shock. It's kind of like the dot-com bust, which took 2.5 years to go from top to bottom. I don't think this will take that long, but that prevented that recession from being as severe as it otherwise might have been. But as we know, the situation that is occurring is that the Federal Reserve is tightening. They should never be tightening. Quantitative easing has to be exponential because every time they have tightened, they have had to reverse their tightening and do more money printing. In fact, let's go back to the 5-year chart to talk about that. Look at this correction in late 2018. The Federal Reserve was tightening and raising interest rates. The stock market crashed. All economic indicators started to deteriorate very quickly, and they had to do more quantitative easing. And that was ongoing even before COVID-19. COVID-19 forced them to do more QE, which is what they should have been doing anyway, but that caused this rally because they overshot again. And the overshooting was not because of too much money printing, mind you. It was because of too few assets being purchased by the Federal Reserve, too narrow of a type of money printing, as I talk about in other videos over here. But now they're tightening again, which they shouldn't be doing. They should just coast in cruise control for a while for the digestion process to occur. So the correction we saw over here when they tried to tighten before is just happening again at a much larger scale. Let me go to a logarithmic chart to feature it better. So this correction was of this level of severity, and this one is about the same severity, but it's going to be much more because it has to come all the way down to here. And this, of course, will cause a real recession, and they'll have to print more again. That is how this process always unfolds because there is a conceptual block in the economics establishment. They still think that money printing can be reversed, and therefore they are trying to undo money printing. So to learn much more about this subject, please see my video over here, which is a monthly series, and that is just the most recent month of that monetary creation versus inflation series of videos. If you're relatively new, you should go down that path to understand more about how all of this is connected in a way that the economics establishment and all professionals, PhD economists don't understand because they are stuck in thinking from the mid-20th century. They have no understanding of technology or exponentiality. So this was the S&P 500 chart, and it's really being weighed on by a lot of other things. Rising interest rates, a reversal of money printing, and even worse, high oil prices, which were completely unnecessary, but the byproduct of very bad and misguided government policy in the United States, which caused a chain reaction which led to oil prices becoming even higher. So let me go to oil prices now. This is the United States West Texas Intermediate Oil Futures ETF, USO. And you can see why oil prices are just rising up, up, and up. The Biden administration decided to halt domestic oil and natural gas production, which caused oil prices to go from $50 a barrel to $80 a barrel. Now, unfortunately, at $80 a barrel, a lot of petrostates that were being well behaved because they didn't have that much revenue begin to resume their aggressive actions. The last time Russia invaded Ukraine was 2014 when oil was high. Oil has been low after 2014 until now, but now that it's high again, Russia receives more export revenue and can invade Ukraine and potentially other countries again because it has the resources to do so now. And that pushed oil from $80 a barrel to now what is $120 a barrel, and it's still rising, so it's way up here. This is a very negative economic force because it is worsening consumer purchasing power, it is increasing the trade deficits of all oil importing countries, and it is contributing to what may cause a stock market crash in the short term. Now, this is causing tremendous technological progress in demand destruction for oil. Everything from electrical vehicles as an alternative to work from home video conferencing solutions that eliminate transportation in terms of commuting to work altogether. Those are being accelerated by high oil prices, and the high oil prices here are going to reduce oil demand even faster than was otherwise going to occur. See my video up here for more information about that. It's really an equation that shows how oil, by being high, kind of burns the candle of its own demand at both ends, and then will never be able to get back to the same demand it was before. But short term, this is another problem weighing on the stock market quite a bit in terms of both consumer demand as well as companies that have to use oil as part of their business operations, companies involved in import, export of components or finished products or things like that. So this is a big negative pressure on the stock market for sure. So the crash watch is still very much on, and I don't know when exactly it will occur, but as they continue to tighten, I'd be surprised if we didn't have a deeper crash between now and October. These are all the bearish factors piling up, but none more so than the Federal Reserve tightening, which they should not be doing, and the United States halting domestic oil and natural gas production, which is what it should not have done at all, because that has emboldened oil petrostates that were behaving well for the prior 8 years. So this is the Crash Watch for June 5th, 2022. I hope you found this informative, and I hope this video continues to be useful to viewers well into the future because of the fundamental principles you can learn about in this video even long after the market has progressed quite a bit after this date and the crash has manifested. These are for educational purposes and hopefully of an evergreen nature. Now, if you like this type of content, I encourage you to subscribe to this channel. Thank you very much for watching.